Hello, hello. Sorry to anybody that was in here checking this out. I had some technical difficulties. My stream crashed. I will have to look into that. I've never had that happen. So, moving on. All right, we are on episode 2 of the Observer sessions for the foundational logic, entry level trading concepts, how to understand support and resistance, read candles, the very beginning. Last week we covered the tools of the trade. We went over using TradingView, reading a candle, what the candle tells you, trends, ranges, so on and so forth. Okay, so tonight we're just going to dive right into charts, and I'm going to give everybody live examples of a few things that I would like to go over. So, last week we went over candle bodies. We identified a consolidation range, or a range when prices staying essentially within a box, right? We are just moving sideways. We are not creating massive new highs. We might be just touching and manipulating price just a touch above, but we're not structurally breaking out from a range. We are just staying within, moving sideways. So that is being range bound or consolidating. And tonight we're going to go over what's called the AMD cycle, accumulation. Let me move this over here. Not a good location for that. Manipulation and distribution. Okay? So, a consolidation range also doubles as accumulation. So inside of this range, large ticket players, smart money, institutional traders, they are building large positions. So if they wanted to take shorts or take longs, they are accumulating longs here at this low, and they're doing it in small bits and pieces because they want such massive positions for the day that if they were to just fill their position immediately, they would have slippage upon entry. So meaning they would enter, their position size could cause, a $20 price move. And if they do that, they have already drastically cut their profits. So they're not looking to drive the market higher with this large entry. They just want their entry at the price point that they want it. So in this range, this orange line is called the volume weighted average price. And we see price is just bouncing off of the VWAP, the volume weighted average price, staying range bound, moving sideways. At these lows, and we just see these brief periods of breakout, boom, institutions loading longs, small piece of their position, dips down. They're probably not accumulating here because this is just still so choppy, and there's no candles that have very obvious displacement. All right. So now over here, this little candle that has in this one that have these deep wicks and a healthy mini candle or couple jumps right there. That again is a small amount of accumulation, small amount of accumulation, small amount of accumulation. One of their last punches of accumulation before the New York Open. Institutions have, they do what's called counter position trading to manipulate price. So if they again, now they want, their position is so large that they are trying to fill, there is what's called floating shares available. So at any given time, for them to actually get their fill, they would need enough floating shares available on the table to purchase. That's not always the case. Or 99% of the time, that's not the case. That's why these three cycles exist. So they are accumulating, we are range bound, and then they take a counter position that is large. They are pumping money into shorts, and they have the money to move the market. So they're driving price down, and their goal is, because in this accumulation phase, we're also going to go over what would be called support and resistance. Okay. A lot of entry level traders use support and resistance, within their thinking. So we see this line, and it acts as a floor, That is support, okay? A floor would be support. Up here, and we could even call it this area, we have resistance, all right? Price is resisting this essential invisible wall, and it is just range bound, moving in and out. So this is support and resistance theory. A lot of traders, when they first get into this space, they constantly recognize how, what do we have here? A floor. And this is, people will think they had a breakthrough finding out support and resistance. Oh my God. I did when I first got into this stuff. I thought it was the coolest thing ever to go start drawing lines on the charts, and you'll see, you come over here and, oh, what do we have? A wick that comes down, support, support. And it's really, these also line up with what's called pivot points. And if we were to pull out what's called a volume profile, all these things come into play. These aren't just coincidentally lines that act as support and resistance. These are specific price levels that represent pivots, or round dollar amounts, like 390.00 over here on the right. Whole numbers, not 391 or 387. That's not exactly a whole number. But if we were to go 26,004, you're going to roll around, you're going to find plenty of resistance at these levels, because institutions love whole numbers. So either way, we have support and we have resistance. Now, institutional traders are loading up their positions, and they already have a set plan for where they want to see the market trend for the day. They could be taking longs, they could be taking shorts. So we always try and recognize the accumulation of institutional traders, the manipulation cycle. So they want as many longs as they can get for this move here, which are buys. Buys are longs, shorts are sells. In futures, you can, because you never own the asset, you are essentially writing an IOU. You can sell the asset with an IOU, saying, I want to sell this here even though I don't own it, and I'm going to buy it back down here at a lower price, and I want to keep the difference in between. So they will accumulate their long positions. In this example, they were going long, and then they will take counter trend positions from within their firm or however they're trading. So they will take a counter trend position, and they will drive price below these support levels, because tons of retail traders will see price break out, or they will, in this area, be shopping for longs, and they think that we are super bullish on the day, and they're not wrong. But say they're targeting these highs from London. Those are just extended across my screen. They would have their stop loss below the resistance line. Okay, so hypothetically, they'd probably be in more around here with a stop loss lining up with all of this support, the basis, the floor that price has been rejecting. Okay, institutions know this. They can see it on the depth of market. Your stop loss limit order shows up over here. If you're taking a long, a stop loss is, you're now borrowing, you're writing an IOU that you're buying a share, or however many micros or minis that you're trading. So you're purchasing shares, and say you purchase an IOU that you're going to buy shares and you're going to sell them at a higher price or a premium. And you would, enter your position, and when you place this stop loss here, this order on the screen, this is a limit order. That's your stop loss order, how much you're willing to risk. And this would be what you're looking to make, okay? So if you were to actually follow through with that order, that Stop loss order, if you bought one, you would sell one when you're down here at a loss. So that will reflect over here. And if a lot of traders are on the opposite side of the fence, smart money institutions, they have the capital to purchase your shares. They want you. They want them. You are trading. If you are selling a share at a profit, somebody is buying that from you. Everything is a trade. It's a transaction here. So when they know you have your stop loss orders down here and there's not enough floating shares available for them to fill the position size that they would like, what are they going to do? So even though they're buying longs all day and that is their goal and objective to take longs, they take a counter trend position and they have the capital to just push and buy the available as many available shares as they can at market orders, and they will probably lose a little bit of money in slippage, or they're not worried about profits. I'm sorry, it's not that they'll lose money in slippage, it's just they're not going to get a desired upon fill price. Their average fill price, instead of being where they loaded shorts up here where this candle turned bearish, their average fill price could potentially be all the way down here, because that's called slippage. They bought so many that they didn't have enough at the desired level, so the order got filled at lower levels. So they do this intentionally. They punch price down into this support line to purchase retail shares at stop losses. So as soon as they punch down into these liquidity pools, they then immediately purchase all of those available shares now, and then begins the distribution leg. So that's accumulation, manipulate lower. We manipulate the lows of this range to execute stop loss orders of retail traders, and then we see a change in the state of delivery and distribution. So next thing on the list, but we have accumulation and consolidation, manipulation and distribution. Okay, so last week we covered how to read a candle body, time frames, the tools of TradingView, how to download TradingView, use it. We went over what a candle tells you, recognizing trends, uptrends, downtrends, being range bound. So being range bound is a consolidation range. That is smart money accumulating positions, manipulation, and then distribution. This will be a very important thing for you to understand throughout your trading journey. So now I want to go over what is a change in the state of delivery, a CISD, or a change of character, or a market structure shift. Okay, so change in the state of delivery. Now, last week when we were discussing trends, that is when we have a high, a low, higher high, lower low, lower high, lower high, lower low, lower high, lower low, downtrend, okay? A change in the state of delivery is when we go from, so right here, we're still respecting trend. We have a lower low, we create a lower high, but now we've created a higher low. And then, boom, a higher high. And we need to see the candle body close above this level. If the candle body just touched this level and wicked the wick right here, if we just saw the wick go up beyond the tops of these candles, that is not considered a valid change in the state of delivery. We need to see this blue candle close higher, creating a higher high, and then we have a higher low, higher high, higher low. Okay, so There's a million different ways that you can trade this. You can trade through inversions, order flow. This is all going to sound like gibberish where you're entry level. There's optimal trade entry. I guarantee you this is a perfect example of ICT's optimal trade entry. Price went up, retraced back down perfectly into the 0.7 range, and then bang, you could have hit a 1 to 4. So we're not going to go there yet. But accumulation, manipulation, distribution. A change in the state of delivery is when a trend, going from, I'm not even going to draw it out, it's going to take forever. Higher high, higher low, higher high, higher low, higher high, higher low, all the way up here, right? We're respecting trend. But then up here, what do we have? This is the most recent low. Okay. Boom. That right there, the candle body closed below this low. Change in the state of delivery. And then we formed a lower high or low. Okay. CISDs aren't exactly something that you want to just enter a trade off of, but paired with other confluences, CISDs can be enough. A lot of times I will just take trades off of a change in the state of delivery paired with, order flow confluences. That will sound very confusing. But, I did it. I deleted my indicator there. Let me clean up my charts. This is going to look crazy for you guys. Oh, let me just delete these ones. Bear with me. I'm sorry. Okay, so we are also looking tonight at live price action. So right now, we have entered what's called Asia session. Now, in school, when did you only on an X and Y axis chart focus on price on a Y axis alone? You don't. Every X and Y axis chart, time is just as important. The market runs on algorithms, but it is, of course, the vehicle's driven by auction market theory, but it is algorithm based. It's not a coincidence that, right in between 8:15 and 8:45, almost every single night between the Asian session, you will have a reversal move, or in this case, boom right here, and you'd want to see confirmation. I'm getting ahead of myself here, sorry. But tonight is live price action. So I want to go over what this story is telling. Okay. So we're consolidating right here. Where these lines are put across, I have an indicator that's just marking out for me so that I don't have to. Everywhere that there is a relative equal high or a relative equal low, meaning the candle wicks hit the exact same tick level, which is a quarter, 25 cents, the exact same tick level as a candle that's near. So relative equal lows, relative equal highs. So these lows, and we also have relative equal highs. This is pretty much forming your support and resistance, right? So where do support and resistance traders who are taking longs right here put their stop loss? They don't want to risk. They got filled up in here. Their stop loss is resting below these lows right here. Maybe they're targeting just an arbitrary shot. They could be targeting these highs. They could be targeting a totally different level. But what does smart money do? Drives price down, manipulates the lows here, these candle wicks. That's called absorption. A little advanced, but we see price getting absorbed, a resweep of the lows, And we have, well, even right here, we have a change in the state of delivery. So that's why I was saying a lot of times you really can't just enter off a change in the state of delivery without order flow confirmation. Okay, we have low. This candle is not much of a high. You could consider it a change in the state of delivery, but it's not very valid. You know, if you went here, boom. That's a joke of a trade. But hypothetically, if you took this and you were targeting these highs, you're getting stopped out. Your stop loss, retail stop loss, or ICT teachings, anybody with SMC trading habits is going to put their stop loss down here. What do? Reswept the lows. Smart money loaded up more floating shares down here after executing your stop loss orders. Now they purchase and scoop those up, and then we see, boom, large expansion. So even right here, we have accumulation, manipulation. I don't have presets for those because I don't mark them. I just recognize it. Accumulation, manipulation, distribution. Okay? You see this repeating all of the time. Right now, we are in super bullish price action. Well, today was pretty seek and destroy, which means that the market opened, swept liquidity above these highs, stop loss orders executed, and then turned around, swept liquidity below these lows, dug deeper for continuation trends down to the volume weighted price average, or volume weighted average price. Breaker block also lines up directly across with that. Extends over, acts as support at this level, change in the state of delivery. Price goes up, sweeps liquidity of London highs and I believe new all-time highs, then distributed back down to balance this range. And then we just went sideways for the rest of the day, okay? But so tonight we have gone over so far. I want to create or find an example of accumulation, manipulation, and distribution in a bearish situation. Very ugly price action. Right there. This isn't textbook, but okay, we're range bound, accumulating positions, smart money. Now, here is the manipulation leg. That is the manipulation leg. And then from here, we distribute. So this is an example of smart money or institutional traders, large position players, accumulating, manipulating, and distributing. Okay, accumulation, manipulation below these lows, distribution, accumulation, manipulation above these highs, distribution, targeting the liquidity at these lows, all the way down to these lows, you know. This happens repeatedly. You want to learn to recognize these cycles. Today, I knew that we were either going to be in a seek and destroy profile, which is when both sides of the range are getting swept, or we're going to be bearish. And why did I know that? Because usually Asian session sets the range, which Asian session spans every night in Tokyo. All of the traders, their markets are from 8 p.m. till about midnight. That's when you really want to be playing in there, and it's a combination of the Tokyo session and the Sydney session. It's also Australian traders. So I like from 8 to about midnight. That is your Asian session range. Now, midnight, exactly at midnight, is a price level you generally want to pay attention to as well. A lot of people like to, excuse me, a lot of people like to mark what's called true day open, which is, and set up this indicator to do it for me. Okay. So right here, this dotted line is representing the price at midnight. So the start of a new day. Now, what do? Swept Asia lows. Price gets manipulated. We did sweep these highs as well. So this isn't a super clean AMD model, accumulation and manipulation distribution. It's not textbook, but overall I wouldn't be too concerned about this wick. So I would see accumulation, manipulate, these lows. Where did we reject off of here? What we went over last week. A bullish fair value gap. Bullish fair value gap. Directly right here. Price respects that fair value gap. We have a change in the state of delivery. Candle bodies close above these highs. All this is going to seem like gibberish, but the more you practice this and find it, you can learn to read price action for what it is. Okay, so we have Asian session range. London closed below these levels. Wicking is enough in most cases, but sometimes the velocity and the distribution cycle is going to move so fast that you'll just get a fat wick and then a really large distribution in some cases above. We could sweep a 4-hour low or a 4-hour high. We're going to get into liquidity sweeps as well tonight, but right here, that's essentially what that is. Smart money is sweeping liquidity, which is market orders right here. This is liquidity, 21 orders. That is a heavy pool of liquidity. We have all these large levels of liquidity. Now, they see this information. A lot of us do. So I'm a retail trader. I don't have the money to be targeting levels like an assassin to get these huge position fills. I'm just trying to hang on to the coattails of the institutional traders. So Asia sets the range. London manipulates price. London manipulates lower. After London, we manipulate lower. We respect a bullish 15-minute fair value gap. Get confirmation, change in the state of delivery. New York open, low, and then immediate distribution. Huge distribution leg. So, right here, accumulation. I don't know why I keep looking for a pre-made box. I don't mark this like I said. So gray. Accumulation within this range. Asia highs, Asia lows. All right. We did sweep these levels. But if smart money wants to load a really large position, like one it would take to move these markets like this, a lot of traders aren't trading within these hours in New York. London is super popular, don't get me wrong. I used to wake up all the time for London. I don't anymore. I just like New York. I've really grown to like Asian session over the last couple months. It's been booming. This is very low volume for Asia, but a little bit irrelevant there. So we have Asia accumulation, London manipulation. New York distribution. You see this a lot. And look at that. Boom. You know, this week we've had tons of ceasefire news, so we are just pumping. Fastest market recovery in history. Literally. And insane. So, now let's also talk about EQ of a range. And what is that? So, it is very common to see price balance itself. The market is always seeking to be efficient, meaning price finds balance and then expands. And then it finds balance and then it expands. So what do we have right here? Huge expansion and a 50% retracement. This marks the halfway point for me of this level. Price retraced 50% of the way. I'm so tired. I'm sorry. I'm like lethargic tonight. I'm sorry if I'm doing a poor job. Next one will be better. Children, they wear you out. But retracement to the 50% EQ range. Expansion. Okay. What do we do? Expand it up. Retrace back down to 50% range. Now, I took shorts today when a ton of people took long. Both sides of the aisle won. If you're a good trader, it was a seek and destroy profile, and you could have made money either way. I took my one win and I left. But why I'm thinking shorts, we have not balanced these ranges, okay? Look at this. And we will. It's inevitable. So right now, we are in a market inefficiency, or the market is being inefficient, or it's considered inefficient right now. I think we're going to see retracement to these lows, or that's, kind of unlikely. But I think we're going to start snagging up some liquidity pools inside these areas. It'll all be super confusing. Again, I don't want to overwhelm you. Don't focus on that stuff for tonight. That's a little more advanced. It's hard to, when Wednesday I do the more advanced education and Thursday nights I'm doing entry-level education. Sometimes I get ahead of myself and I'm just addressing more advanced topics than we've already covered. So I apologize if there are any subjects that you want me to go over or something you don't understand. Definitely either hop in the Discord, the QR link on the screen, and ask away, or even just in the YouTube chat, and I will get back to you as soon as possible, or comment on the video, whatever you would like. Okay, so now as I address relative equal highs and lows. All right. These can act as draws on liquidity. If we leave relative equal highs and lows somewhere, it is very likely that we are coming back to that level. Sometimes we don't. There's a lot of gas in this vehicle, but we're in really unstable times right now. 1 week, positive news. Next week, war news, bombs, all sorts of stuff. So really, I've all month been ridiculously low risk in just taking my profits and walking away. Small profits, walking away, and being consistent that way. Now that we've been expanding like this, if this structure holds, I will be going back to, insane risk. A lot of people who took advantage of this made tons and tons of money. I'm more about being consistent for the long haul than worried about becoming a millionaire overnight. That's not my goal. So, moving on, all right? Now, let's go over how to start and form your bias, where you believe or how you are going to assume a trend change prior to it happening. I do recommend always taking continuations and trading with the trend. I only took a short today because I'm an animal. I know where they're at. I shorted this leg over here once I had big confirmation, and I was able to walk away with $500. I was a happy boy. And I left, and that's all I need for the day when we're getting profiles like this. You know, we swept Asia highs. I'm waiting to see a distribution from there. I got confirmation of it. I entered short, took my money, trailed my stop, and I was able to secure a decent little payday. And then I just got out for the day. I don't need to try and catch this monster move. I don't need to try and get back in over here or anywhere. It's not about ripping $1 million out of the screen a day. It's about consistently winning and using good risk management. Okay, so I'm sorry, I got sidetracked earlier. Asia, 8 to midnight. London, 2, 5. New York, 9:30. I don't really like to trade, after lunch, but New York closes at 4:30. That's the end of the New York session. Day open. There's a very common confluence used to recognize trend called the Judas swing, and that was created by ICT, who is Inner Circle Trader. He's an awesome guy. I started becoming profitable off of his concepts. I incorporated order flow into them as well, and my win rate skyrocketed, and so did my return, my risk to reward. Now I'm consistent. This is what I do. So, but a Judas swing is the manipulation, like recognizing the manipulation. So Asia, true day open. Here we have true day open, and we have a price swing below. It's a fake manipulative swing. The real direction, because now we are in a discount, the opposing direction, it's a Judas swing. That's the term that he has coined it, and almost every other trader knows it by. Asia, this is a confusing one because it really isn't an accurate Judas swing there. Not even here either. We've been so bullish. Insanely bullish. The ceasefire news. This is very irregular price action. See that again for years. What a recovery. I mean, the chart moved. The chart moved 1,700 points within the last, 4 days, 5 days. Not $1,700. Big moves. Big moves. Okay. How do you form your bias for the day? So when I log on to my trading day, I start very zoomed out. At the beginning of the week, I still will even look at monthly time frame charts. Most people will tell you don't need to do that, but good to know. What do you have right here? Bullish fair value gap on a monthly chart. Super strong point of resistance. Price broke bearish. Month, bearish. Retraced back into this bullish fair value gap. And then, bam! What a distribution here. We just made up 1, 2, 3, 4, 5 months worth of price action in one. Insane. Absolutely nuts. Okay, moving down. Weekly chart. This was really horrible price action over the last few weeks. Only experienced traders were kind of surviving this. This was very difficult to survive in. As you can see, each one of these candles represents a week right now, because remember last week we went over the time frames. So right now each candle represents a week's worth of price action, and we have very Clear direction, clear direction, clear direction. These tiny candles that are just wicky, that's bad price action. That's very volatile, okay? They're whipsawing in both directions. And where this is a weekly time frame, sometimes these little candles are big moves. $1,800 in a week. Right? Yeah. Yep. Over the last 3 weeks, we've come back 4K. Nutty. Absolutely nutty. Daily candles. But this is what I was talking about in the slideshow in last video where I was saying satellite versus microscope. We start zoomed out. We form our analysis. Bullish candles, bullish candles, bullish candles. So bullish until proven wrong. Don't get me wrong. I am. Higher time frame structure, I am bullish. I'm sorry, I'm getting off topic over stupid TikTok arguments trying to justify why I was thinking shorts today. But it was obvious to me. And again, I made my money and I left. So only a problem if you lose. Now, 9 times out of 10, my morning starts on a 4-hour time frame. And I want to see if price, oh, we didn't create new all-time highs today. Sorry. I would want to see if price is resting. When we opened today, let's see. Okay, today was Thursday. So we had this bearish retracement right here, this tiny black candle. That was my trade this morning. If we were to extend that over, what are we sitting in? Okay, another reason why I was taking shorts. 4-hour fair value gap is very strong. So you can consider those major points of support and resistance, where institutional and major players are likely to take reversal trades out of. Okay. We'd already closed above this and inversed it at this time. I didn't need to see that. What I did see was this inversion, or the likelihood of inversing this. I figured we have so many. So I mentioned last session fair value gaps, right? So when you see stacked fair value gaps like this, these are all considered unmitigated. They are unfilled, okay? And inside of these gaps, there are a lot of times massive amounts of limit orders. So let's find a large pool of bullish limit orders right now. So 24 limit orders sitting at 26,484. So you don't need to do this, but I just want to give you an example. So 26,484, quite a ways away. So other people are anticipating shorts as well, because they wouldn't be setting orders to purchase at these levels if they weren't expecting us to retrace to them. But 26,484, close enough. Okay, we're off by $1.50. What do we have right here? Traders are expecting to see price come back and patch over this whole entire gap. Price is likely to print back over that gap. Okay, so let me give you an example of a gap getting mitigated right here. That was technically a failed inversion manipulation leg right here, leaving 4-hour bullish fair value gaps. Price is trading down, respecting it, completely patching over and sweeping out any orders that are resting in there. Price is digging all around, filling the orders, whether they're stop losses, buy, purchase orders, of any type. Fake out, again, distributing down. What do we have? Next fair value gap. These are bullish fair value gaps, so I'm sorry that that's red. They're bullish. Here we go again. Consolidation. Price again fills in this fair value gap completely, digs all around, searching for liquidity, finding the orders and hammering them out. Then again, fake out up to VWAP, distribution, right back down. What do we got here? Fair value gap. Now, the first presented fair value gap in a leg is the most important one. If you have one fair value gap, two fair value gap, three fair value gap, the most important one is this one. You can almost always guarantee that we're going to retrace back down to it. Not necessarily all the time, okay? But 9 times out of 10. What do you have up here? First presented fair value gap. This is now the beginning of this downtrend, right? In this line, price retraces back up into that first presented fair value gap, distributes. Price, boom, super bullish. Where did we go in here? This leg came down. Why did we go back up here? Mitigate this gap. First presented bearish fair value gap. Consolidation. Retouch this one above again. Distribute. Mitigating these gaps now. Touch back into this bullish fair value gap. Here we go. Mitigating these gaps. These we were mitigating on the way down. We left this one. There wasn't any unmitigated gaps outside of that. Here we go. All of these gaps, price retraced in this run, retraced back up to this first unmitigated gap. Even this second one here, we still have this one left up at this volume weighted average price level. We came back for that later. Okay, consolidated right around these levels. And so this is essentially also a different way of painting support and resistance theory. Fair value gaps are awesome though, so I love these. Everybody does. A lot of people really love fair value gaps. And this is how you can use them to form your support and resistance. Do not think a fair value gap in the middle of a line unless it's paired with something else, okay? So like right here, I just told you not to think that a fair value gap in the middle of a run when there are these fair value gaps unmitigated above it. A lot of times I would not be entertaining shorts out of here, this bearish fair value gap. But the reason that I would be is because we have what is called a breaker block right here too. Now, a breaker block, look at the candle bodies just touching the top of the breaker block. A breaker block paired with a fair value gap is a strong confluence. In a breaker block itself, we have two of them here. We have one right here. And this would be considered a mitigation block. We have another one right here, and we see price respecting that level. It's all not coincidental. Everything is algorithmic. So, a breaker block is when you see price form a V and the last candle in that run is your breaker block. But a breaker block must sweep liquidity. Okay? So, over here, we have lows. It's debatable that this candle swept the liquidity, but either way, I would consider this a breaker block because in this punch, we took out a level that has stop loss orders resting below it. Retail traders got stopped out of their positions here. People had resting orders below this low, guaranteed. Swept liquidity from this low. punch through. Didn't take this one yet. But this level, we stole liquidity on this deep dig. So that forms a breaker block. Okay. Now, a mitigation block you would find in the same fashion. All right. So this run, and these are bullish too. They're not just bearish. So we have a V. It would also be right here. You see this wick? This one's, yeah, we wicked up above the candle body's highs. So this one wicks up. This blue candle. You could even do both of those candles if you wanted. I generally just do the first one. This candle, wick to wick, breaker block. Well, this one would be a mitigation block. No, breaker block. Okay, breaker blocks and mitigation blocks are the same thing. The only difference is a mitigation block doesn't sweep liquidity. So this last candle, no, because the run continues. That's not a mitigation block. This is a breaker block. Pair that with that fair value gap, I would have taken this short, because even though this fair value gap is in the middle of this distribution leg, paired with this strong V shape right here and breaker block, you can entertain shorts out of this area. I would have saw order flow confirmation on that candle. I would have entered somewhere over here, and I would have trailed my stop below every what's called imbalance on the way down. And then when candle, I would have either gotten stopped out down here or whatever, maybe even gotten to the bottom depending on where the imbalances are. I wouldn't have cared. I would have gotten such a fat piece of the pie just off of this one move if my trail stop is, you know, right over here and I'm ripping down. That's a 1 to 5R instead of having a trade. Yeah, I'm getting ahead of myself. The complicated sessions last night, I'm sorry. So breaker block must sweep liquidity. A mitigation block see right here, you could consider this super ugly one. I don't like that example. Not a fan. Okay, right here we have a lonesome black candle sandwiched in between these two blue ones. Notice how the top of that candle did not punch higher than these highs. You know, that right there is a mitigation block. The low of that wick also didn't sweep these lows. We didn't sweep any liquidity with this, but we had a change in the state of delivery. That's a mitigation block. Okay, so a mitigation block doesn't sweep liquidity. A breaker block does. A fair value gap is the gap in candles in a series of 3 candles, the gap in between the wicks of the outer candles. Okay. Now, I don't want to overload you with price action information, and I have a feeling like I just kind of did. I'm super tired, and I apologize for the poor quality of the stream tonight. I assure you they'll be better. Last night I put a lot of work into last night's stream for the advanced stuff, and I am new on this journey when it comes to not to trading, but into diving into the social media world and gaining attention and trying to give some free education out. So you know, I really suggest reviewing my mumbo jumbo from tonight. Sorry if it was laid out in a boring fashion. As far as price action, I would watch it again, get really familiar with accumulation, manipulation, distribution cycles. Go back into your own charts, try and find them, mark them out. recognize them. If you have any questions, hop in the Discord, ask me. I will spend time answering your questions. I don't mind. I'm here to help. Okay, so we're going to get off the charts for right now, and we are going to go to our slideshow, and not our slideshow. You're going to pull up our risk management section of our trading playbook. This you can find for free in my Discord. It's a 3-page trading playbook with all sorts of, I think, very useful information in it. Just completely free. Download the PDF out of the tools for the trade section. All right. Last week I went over risking 1% of capital per trade, and I want to go a little more into depth about what that means. Okay. So if you have a $25,000 prop firm account, to risk 1% or a $50,000, which is super common. I have those two. I actually prefer the 50s over the 25s, but 25 was a great account to get going with too. I've had it for a long time. So 250 for 1% of a 25,000, 500 for 1% of a $50,000 account. So I like to risk 0.5% per trade, so that way if my first trade idea fails, I have capital to go back in with a second trade, and there's a chance that I'm going to reverse my day. Worst case scenario, I'm going to end my day, at or very close to 1% in loss, which is very manageable. Losing 1% is not the end of the world. So that won't dig a huge hole into your account and get you to blow up all of your hard work and throw it away. So in here, we have a position sizing guide, okay? So the NASDAQ pays you the NASDAQ pays you $2 per point. So what that means is that for every dollar that the NASDAQ moves, or MNQ, micro NASDAQ contracts, that is $2 you are either making or losing for every dollar that the chart moves. So if the chart moves 100 points, that is $200 in either direction. Okay? So if you wanted to risk 250 or 240, when I was on the chart and I held down shift on my keyboard, click the area I want, I can measure very fast. And inside of this box, that first number, that is telling me how many points I am for whatever I'm measuring, okay? So that's how you will very quickly measure the distance that you are thinking for your stop loss. A lot of times it's going to come with experience. You're going to look over and you're going to find the level of the candle body's low with your eye, and then you're going to do the math if the candle closed 10 or 20 points above it. And then, you frequently make trades, you are going to calculate your position size inside of your head. So, but I gave you this because when I was first starting, I literally printed it out and I would have it taped on my wall behind my computer. So that way I could just flash my head over and look really quickly, and I would calculate my position size. I had it already written out for me right here. So if your stop loss was 10 points away, that's risking $20 per contract right here. Maximum number of contracts that you would take is 12, because that would equal $240 worth of risk if we went to full stop loss. I recommend doing half of that so that you have 2 opportunities. You don't have to, but you can. Up to you. Now, I give you this table. This goes over very in depth. I really recommend going into, and this also helps you and converting this table. If you have a $50,000 account and you don't have a 25K account, this will help you show you how to very easily convert the math so that have this tool right at your fingertips every single day. I'm so sorry. We're coming to an end. Bear with me. All right. Last slide. I essentially wanted to point out at our Discord. We have the QR code on screen. If you would like to join, I really recommend it. I'm at your fingertips to help you along your journey. You will definitely get a lot more interaction than just going back and watching these videos. Well, I really appreciate if you are here and you followed this video to the end. I do again apologize about the lethargicness that I got going on here tonight, but I'm very worn out. I have children and I'm staying up late and I'm grinding, putting together slides and education subjects and following chart flows and yada yada. Never ending life of a very busy man. So, either way, please join the Discord. Tons and tons and tons of free resources. I just want to help you. I'm not trying to sell you a course, okay? I'm giving away free education. Don't trust the guys that are charging an arm and a leg and don't have live trading accounts. If you're not good enough to have a live trading account, chances are you are not a consistently profitable trader and you are living off of your Discord profits. So again, please feel free to join our community. Hop in. I'm going to build up the largest team of assassins in the marketplace that I can, and I just want everyone to be able to reap the rewards of the freedom of this. It will take dedication, but you can do it. So any questions, please feel free to ask. Hop in the Discord and let me know how I did in the comments sections. If you got any tips or any pointers, if you think I smack my lips too much or I'm, obnoxious when I do something, let me know. I'll make sure to stop. I want to continuously improve. I love constructive criticism. I am always trying to get better every day. So